In the 1990s, career advisors tell college graduates to find a good company, put your head down, work hard, and the promotions will come. And this advice works because corporate hierarchies still function like pyramids, with clear paths from entry level to management to executive. And companies invest in employees because replacing them costs more than promoting them. The average worker stays at a company for 7 years, and during those 7 years, they typically receive 2 or 3 promotions, with salary increases of 15 to 25% each time. And this pattern holds across industries from manufacturing to finance to technology. Loyalty is rewarded with pension contributions, better benefits, and preferential treatment when director positions open up. Today, the same advice leads to wage stagnation, and workers who stay at one company for 5 years earn 20 to 30% less than workers who change jobs every 2 to 3 years. The hard worker who follows 1990s advice watches newer employees with less experience get hired above them at higher salaries, and after 10 years of loyalty, they're making 15% less than market rate while doing the work of 3 people because the positions that used to support them no longer exist. But career advice wasn't the only place where conventional wisdom failed. In the 1990s, real estate professionals and financial advisors repeat the mantra that property values always increase over time. And this belief is supported by 50 years of data showing consistent appreciation across most American markets. And buying a house is considered the safest investment you can make because land is finite and population grows. The advice extends beyond primary residences, and people buy investment properties with minimal down payments and adjustable rate mortgages because the appreciation will cover any risk, and flipping houses becomes a casual weekend activity, and television shows celebrate people who quit their jobs to buy, renovate, and sell properties full-time. In 2008, housing prices dropped by 30 to 50% in most markets, and millions of homeowners find themselves underwater, owing more on their mortgages than their houses are worth. The crash reveals that real estate moves in cycles like everything else, and the people who bought in 2005 and 2006 believing prices would never fall spend the next decade waiting to break even, and some still haven't recovered. Though real estate destroyed wealth slowly, the next piece of advice created debt that never ends. In the 90s, guidance counselors tell high school students not to worry about student loans because college graduates earn significantly more than non-graduates, and the debt will be manageable and quick to pay off. And this advice is mathematically sound because the average student graduates with $8,000 to $12,000 in loans, which equals about 1 semester's salary at an entry-level professional job. The typical repayment period is 5 to 7 years, and most graduates finish paying off their loans by age 30. And the investment in education produces clear returns because the wage premium for college graduates is substantial and growing. Today, the same advice creates permanent debt, and the average student graduates with $35,000 to $40,000 in loans, and many have $60,000 to $100,000 or more, and the entry-level salaries have not increased proportionally. The borrowers who took this advice in 2005 or 2010 or 2015 are now in their 30s and 40s, still making payments, and many have paid more than they originally borrowed, but still owe the full principal because the interest compounds faster than the minimum payments can reduce it, and the debt affects their ability to buy homes, start businesses, save for retirement, or have children. The advice worked when it was given because the economic conditions that made it work were real and observable. And the people who gave this advice weren't lying or stupid, they were extrapolating from decades of consistent patterns that suddenly stopped being consistent.